Hi, my name is Mike Converse with the Converse team, and we have a special guest with us today, Michael Turner with American Century. Michael, as we're looking at things in today's market, we're seeing a lot of market volatility. What should investors be thinking of in today's environment?
Yeah, so at American Century, we're really talking to our investors in a couple of different ways. We want them to buy right, sit tight, keep their emotions in check, capitalize on any potential volatility in the market, and then stay diversified. And I'll explain a little bit more what I mean. From a buy right, sit tight perspective, we have a chart behind me. And what we did at American Century is we looked at the trailing 20 years ending 12/31/18, and we say, what would $10,000 have turned into if number one, you missed the 30 best days in the market? And if you did, your $10,000 would have turned into a little over $6,000. You literally would have lost money because of emotional decisions. If you would have missed the 20 best days in the market, your $10,000 would have almost broke even at a little over $9,000. If you would have missed the 10 best days in the market, your investment of $10,000 would have grown to just about $14,000. But if you would have stayed fully invested, your money would have tripled and come in at almost $29,000. So again, it's time in the market, not timing the market that matters. Secondly, keeping your emotions in check. This is really, really important. A good example of this, we all know the buy low, sell high mantra, but investors typically do the opposite. In the year 2000, the stock market was booming, money flooded into equities, the tech bubble burst, and in 2002, we saw investors pull their money out right before stocks took off again. So we don't want to have our investors do that. The third is, if there is volatility, capitalize on these downturns in the market. We went back to 1928, and there's been 14 bear markets, meaning the market went down 20% or more. The average loss during those bear markets was nearly 40%, and the average time was nearly 21 months. But if investors stayed the course, they were rewarded. Coming out of bear markets, on average, in the 1-year time frame, investors earned about 47%. The 5-year time frame, they earned nearly 109% on average, and over a 10-year time period, they earned nearly 200%. The last thing is stay diversified. We've all heard the mantra, don't keep all your eggs in one basket. The same thing should be true with your money. You want to invest your money across a lot of different asset classes, and when you're diversified, that means some things are going to do really well, and some things aren't going to do well, but it's going to smooth out the ride for you and your money.
Thank you so much, Michael. That was terrific advice. As always, remember what you're investing for. Is it short-term stuff? Is it long-term stuff? And again, that leads maybe to how much risk you're wanting to take in those accounts as well. But again, very, very great information. Thank you so much.
Welcome.